Hello, everybody. Thank you for joining us today, and welcome to a webinar on the war in Ukraine and its latest implications for multinationals globally. We have a lot to cover and a very interesting discussion ahead of us, so looking forward to having you join us. As a reminder, you're welcome to ask any questions throughout on anything you hear, which we'll try to address in the Q&A section at the end of this conversation. That said, I realize that some of you might be new to Frontier View, and I wanted to take a minute to provide you with a very quick overview of our firm and how we work with executives at major multinationals. Frontier View provides the world's best market intelligence and advisory services for global business professionals. We help clients grow and win in their most important markets by informing and empowering their market monitoring, planning, execution, and other critical decision processes that they're involved in. With continuous research and insights, custom solutions, and transaction support services, we provide our clients, of which you will see a small sample now, with timely, actionable insights to adapt and win in changing markets. If you're not a client, to receive complimentary access to our Frontier View program so that you and your colleagues can receive our insights straight away, simply email us at info@frontierview.com. And then finally, before we get started, I also encourage you to download our Frontier View mobile app. This app includes all the relevant content you need to monitor markets, including the webinar and the presentation deck that we're about to have today, as well as our daily news commentary on topics such as the situation in Ukraine and its implications for companies. Today, I'm joined by two colleagues of mine, Elizabeth Russ, who leads our global economics research practice, and Mark McNamee, who has the unenviable job of covering Europe research, but himself being a specialist in Russia and CIS markets, he'll cover for us the outlook for the situation in Ukraine. In terms of the agenda, we'll start by taking a big step back and looking at what does all of this mean for multinationals that are trying to build a business globally, and what are some of the things that we suggest executives consider given the situation that we're in right now. We will then go into a conversation around the latest on the outlook for the Russia-Ukraine war and share some scenarios with you that we're working with clients on. And of course, we will look at the global ripple effects, which are manifold, exceptionally complex, and we're only scratching the surface of them. Really, we're likely to see a lot more of that materialize shortly. All of these are areas where there's a lot more content where this comes from. So happy to answer questions. If something catches your eye, let us know. Again, use the Q&A function and message Frontier View webinars with any questions throughout, which we'll try to answer at the end of the presentation or as a follow-up after the webinar if we are not able to cover everything in time. Now, with that, I'd like to start by just summarizing a few of the implications that we see for multinational executives, in particular, companies with global portfolios. These focus on actions outside of the context of dealing with the direct fallout for Russia and for Ukraine that companies are dealing with very closely right now, but takes a bigger picture look at some of the impacts that this crisis is having. And they truly are global. This is, while it's a crisis in Europe and it's a big crisis in Eastern Europe, it really will affect companies and their operations across most markets globally through a range of ripple effects, the most important of which we think is through inflationary pressures. This was an issue before the war. It is a massive, massive problem right now on a couple of levels. First, multinationals were already looking at their pricing strategies and ways in which they can pass through their input cost increases onto their customers. They were trying to understand the level of price sensitivity that they might face, but there was generally a certain level of confidence that most price increases will be able to be absorbed, and there's not going to be a demand backlash, if you will, on some of these price increases. This picture is now different, and we suggest that companies think long and hard about exactly what price sensitivity assumptions they're pushing through. As their input costs increase, we expect to see more price increases necessary relative to what was originally built into 2022 plans. And this might require efforts to resegment target customer groups, understand which ones might be more resilient to certain increases in pricing, and where demand might actually be highly sensitive, and that could drive different decisions around product portfolios, R&D, but we're going beyond pure price increases and really looking at the value proposition, the offering, and technology and product side that needs to support that, not just for a year from now, but really for this year as well. This is also related to the risks we see on demand. And you will see in some of our forecast discussions, we expect that this crisis is going to reduce overall global growth. In some markets, that will be quite substantial. And as a result, we might be seeing more unpredictable demand, more weak demand, and areas where perhaps were not built into original plans the multinationals were having for this year. And we're talking not just about the immediate countries affected, Russia and Ukraine. We're talking about markets like Europe, for example, and also countries that may have dependencies and linkages through supply chains, commodities, etc., to those markets. I think it's also very clear that we're seeing a substantial increase in political risk. Again, outside of the context of just the conflict, we expect that in particular high fuel and energy prices and high food prices are really tinder for political crises around the world. And we will see more and more of that risk starting to materialize as the year progresses and as many consumers around the world are facing anything from just skyrocketing cost of living to even things like food shortages, for example. This directly comes with political risk exposure, and we recommend that companies think hard about where that risk might be highest, and they're really working with their local teams. In some cases, building scenarios to understand what that might mean for critical elections, for particular policy decisions that need to be made, for how governments would prioritize their own spending priorities, and where they might be able to direct scarce resources, and of course any risk of social discontent that might erupt at any point. In addition, we expect that the crisis is going to deepen the issues that global supply chains have been facing, and as a result, it will really drive home the need for taking a big step back and relooking at what that supply chain structure needs to look like long term. This was already something companies were thinking of doing, but it will become even more acute now. And the challenge we've seen is that many companies are so focused on firefighting and just dealing with the daily disruptions that there's not enough time and energy left for the restructuring element of the big picture. What does my supply chain need to look like in the next 5 to 10 years to lay that foundation now? We recommend creating some of the resources necessary to think strategically around supply chains, because it's unlikely that this year is going to not involve a lot of firefighting still. And teams can get quite delayed in thinking through these bigger questions if they're not properly resourced. And this links us to the last implication, which is around 2023 planning. We know that many companies have their planning season start in a very high level in May time, June time, and then proper budgeting work starts in August, September time. We think that nobody has visibility on 2023 right now. And in fact, we suspect nobody's thinking about it, which makes sense given the massive disruption we're having. However, a lot of the decisions the companies need to make today about product portfolio, prioritizing markets for investment, where do you make up for lost revenue in Russia and Ukraine from other places, how do you restructure supply chains? These are structural questions that require a strong point of view next year in order to make some decisions today that are not just about the short term and dealing with the very immediate issues, but are setting you up for a strong growth and profitability path going into 2023. So this is where we suggest that leadership teams in particular take a big step back and think about what next year might look like and work backwards in making some of the short-term decisions they're being pressed to do right now. So a lot of implications, and we will look at what is driving some of these recommendations in a minute. And at this point, I will pass it on to my colleague, Mark, who will cover our latest outlook on the war. You will probably have a lot of questions for him. He will not be able to answer all of them, but do send them along and we'll do our best in the Q&A to clarify anything that is not clear.
Great, thank you, Martina. So as mentioned, of course, this is an extraordinarily complex topic. I'm going to try to cover it here in about 10 to 15 minutes or so. So this will be a relatively high level view. Please, of course, include your questions here and we can try to get to those at the end. But basically, I'll walk through kind of our scenarios, at least our scenarios as we see them for the foreseeable future, meaning the next literal days, weeks, next several months. And obviously, after that point, there are quite literally an infinite amount of scenarios as to the trajectory that this war will take and its eventual resolution. So we'll talk about the scenarios for the immediate future here, what we're seeing for the next several months, and then we'll move into a bit longer term, how we anticipate some things moving, and then more specifically the impact on the Russian market, the economy for this year, and then what we're hearing from companies, what companies can expect next, operational sort of responses that we're seeing from companies. So related to the scenarios, as you can see here, the most likely scenario from where we're sitting today, as Putin was unable, of course, to achieve what he believed was going to be his snap victory and the easy objective of sort of seizing Kiev, overthrowing Zelensky, installing a puppet regime, effectively run out of Moscow. That, of course, has not occurred. Something to that effect could occur, but to be perfectly honest, you see the media talking about Zelensky being in office, or if he's eventually overthrown or removed in some manner from office, or if Kiev falls and the Russian military takes Kiev. Frankly, those questions are relatively irrelevant as to how this war proceeds. Whether Kiev is taken or not, we are going to see a protracted stalemate now, quite clearly, for as long at least as Vladimir Putin remains in office. Protracted stalemate, by the way, effectively does mean we are moving from the initial invasion and war into a counterinsurgency phase of the conflict. So something more akin in the coming days and weeks, something more akin to an Afghanistan type situation. Now, obviously, trying to be controlled by Moscow. The whole point here is that that's the overwhelming likelihood. This means, of course, sanctions stay in place. We're assuming also under these conditions that as long as Putin remains president, which is our expectation for the foreseeable future, though there are, for the first time, obviously in 20 some years, the biggest threats to his regime that we've seen, which do raise some critical questions around the stability of this regime and how long this can last in light of the sanctions pressure on the domestic economy, plus what is going to become an increasingly bloody and costly war that'll become increasingly unpopular domestically within Russia. So what does this mean? We have seen, in fact, Putin now sort of upping the stakes, escalating, as we've seen at every turn in the conflict so far, escalating with threats of banning exports of primary commodities out of Russia, which we anticipate these will be announced in the next 2 weeks. We expect that would include gas, specifically, because that would be most damaging to Europe in particular, and also the government budget relies more heavily on proceeds from oil exports than gas. So it would be a little bit less damaging to the Russian economy, while more damaging, of course, to the West. So we are anticipating that to occur, which of course would have significant impacts naturally on the rest of Europe and global commodity prices. Moving to some of the other scenarios. Now, again, just a quick word. These are all under the current assumption, which has actually been confirmed today, this protracted stalemate scenario of an inability to come to some sort of ceasefire or a peace deal. We even saw the foreign ministers of Ukraine and Russia meeting today in Turkey, ended the meeting, in fact, early, and both reported no progress. However, that said, there are small slivers of some hope here of moving towards the far right scenario of a potential turnaround in Russian policy. We do not see this as particularly likely from where we are sitting today, and particularly after the peace talks that we saw in Turkey today. But the fact that we have seen Moscow moderately and unilaterally sort of lower its demands for its political objectives in Ukraine over the last couple of days, which is relatively encouraging. We've also seen Zelensky and his foreign minister also repeat that they're open to compromise and finding some sort of solution to end the hostilities. So that's moderately encouraging, though still relatively unlikely. Slightly more likely than where we were a week ago, or almost nearly 2 weeks ago, when, of course, Putin raised the nuclear threat level. So this is at least moving things slightly in a better direction. Now, the middle scenario, the least likely, but quite dangerous, of course, and could rise over time as we have a protracted stalemate, as we have a counterinsurgency movement, the threat of NATO becoming involved. This would unlikely occur from the West's initiative, but would more likely occur from a mistake, an inadvertent, say, bombing in NATO territory in Poland, right across the border from Ukraine, something like that, some sort of miscommunication potentially, which would then bring NATO involvement and then escalate things, of course, into World War III, which then, of course, raises the threat of a potential nuclear exchange in that particular scenario. In addition, this scenario could also be driven by Putin's decision in the coming months as he's facing more pressure, rising disapproval on the streets, rising pressure from elites in his circle, to then overtly expand the conflict to involve NATO in order to try to maybe garner greater domestic support, a rally around the flag effect, by initiating a war not just against Ukraine, but a war against NATO. Again, still relatively unlikely, but this are the defining features of that sort of middle case scenario here as defined. If we can move to the next slide here. Over the longer term, as mentioned, right, so this counterinsurgency, it would continue for the foreseeable future. Again, whether this takes months or years, eventually this does become more or less unsustainable. As we've seen counterinsurgency movements, whether it be the Soviet Union and Afghanistan in the 1980s, the United States and Afghanistan, numerous other areas where counterinsurgency movements have been extraordinarily difficult to help achieve political objectives. So this is where we see things over time. Now, again, there are infinite amount of scenarios for how this can develop. What does Ukraine look like in the interim, in this transition, and then by the end of the conflict? But frankly, from where we're sitting today, those are rather immaterial questions to be really discussing about what the nation of Ukraine or how many partitions of Ukraine we could be looking at in various scenarios in the future. And related to the economic impact, what I would say, and this is clear from numerous discussions with clients, of course, operating in the markets, is that the market is still severely underestimating the financial and economic trauma that is going to be coming to the Russian market in the very near future, unfortunately. This crisis is going to be considerably worse than what has been seen at any period really since the fall of the Soviet Union in the early 1990s, when you had 3 years of consistent contraction of the Russian economy. Effectively, without going into every single detail, in each of the previous major crises, 1998, 2009, global financial crisis, 2015, oil price collapse, in each of these cases, typically the economy would be protected by some area of demand that could help the economy revive over time. Whether that be in 1998, an IMF program, a revival of foreign capital coming into the market, taking advantage of the weaker currency to boost exports, and you did see a pretty swift revival after that pretty considerable collapse of the economy in 1998. You don't have any, unfortunately, under such extreme sanctions pressure. Again, these are the most extreme sanctions ever enacted against a single nation, and they are also the most extreme sanctions enacted against an economic entity of this size. So we're going to be seeing a financial crisis inevitably in the coming weeks, which is going to then turn into an economic crisis within Russia. This is what underpins our expectations here. I can also say that the consensus currently is foreseeing the economy to drop this year by about 9 to 10%. However, those forecasts were made, the consensus forecasts were made without including the upcoming bans on Russian commodities, and critically, expectations for bans on oil and gas that will be coming. Whether they're full bans or limits, however many categories of commodities are included, nonetheless, that's going to bring that consensus down. That's going to make the forecast closer to where we are, which is around minus 16%. In addition, a lot of the problems are coming, of course, from the extreme ruble depreciation, which relates naturally to the financial sanctions. But more critically, the inflationary impact is not actually coming from the ruble depreciation. That worsens it dramatically, but the critical point here is that inflation is being driven up dramatically because one, already inflation was at relatively high levels, and then two, as a result specifically of the sanctions, we're seeing extreme shortages of imports, and we're seeing a lot of problems domestically within Russia of transporting product around the country. Those problems are going to worsen very quickly, particularly as interest rates already raised to 20%, which again, those interest rates are higher than they were in 2015, for example, when you saw the ruble lose half of its value then. And we're going to be seeing the interest rates likely going from 20% to pushing 30% at the next central bank meeting. That, of course, is going to freeze domestic investment on top of already the lack of access to foreign capital and the as we've seen the financial stoppage of capital over the last couple of weeks. All of these conditions, unfortunately, are going to drive a significant contraction of the economy, drive up unemployment, reduce wages, of course, and hence this is what underpins our pretty extreme scenario for the Russian economy. And again, the political impact of such an unexpected financial and economic duress on the population, matched with what is going to become an increasingly unpopular counterinsurgency war that Russia is fighting in Ukraine, is going to put extraordinary pressure on the stability of Putin's regime. And lastly, sort of what companies should be looking out for in the next steps. Hopefully, we can see further moderation of Russia's demands, particularly as all of these financial and economic and military pressures accrue. But you are going to see, of course, this counterinsurgency phase of the war. The concern here, as mentioned, would be as you're getting, of course, as hostilities escalate, the worry about whether inadvertently or overtly this becoming more of a world war and a NATO-Russia conflict. In terms of sanctions, we've already seen the central bank sanctions. Those are, by the way, the most extreme sanctions, and this is why we're seeing such financial trauma coming to Russia in the immediate future. This also was likely not included in Putin's calculation to invade Ukraine, which encouraged him thinking that he had his $650 billion war chest, which he actually cannot deploy in light of those assets being frozen abroad. SWIFT bans and bans on transactions with major banks, these are also very impactful, but not quite as impactful as the central bank sanctions. And then we've seen the US and UK ban imports of oil, more symbolic, but it does have somewhat of an impact. Neither country imports that much oil from Russia. And also Russia's having a little bit of difficulty actually exporting to other markets, considering all of the worries about potential sanctions violations by any country importing Russian oil. And now we're hearing more worryingly, the EU saying they're going to actively reduce demand for Russian gas, which Putin countered by saying he would be banning certain commodity exports, which is likely to include gas. So we'll talk more about that, the impact on Europe in a bit, but that would then, of course, cause considerable harm for European markets, but this would inflict drastic self-harm on the Russian economy. Now, as far as companies are concerned, implications, what we're hearing from the market, several things. First and foremost, protecting employees and assets on the ground. Of course, this is of primary importance for all of our clients that we're hearing from. We would also mention, though, speaking with the clients that are active in the market, we would say slightly over half of them actually do intend to stay and have not had actual formal discussions about pulling out of the market in some fashion, whether that meant actual full exit or suspending operations temporarily. Slightly under half of our clients are currently considering or in active discussions for, in some form, suspending operations or other fully exiting from the market, whereas a pretty extreme minority of our clients have actually fully exited from the market as of today. So we still see most of our clients in a wait and see mode, but we also understand there's sort of a timeline involved. It depends on the company, but we're talking 1, 2 months, 3 months to see how, of course, this war progresses, how the sanctions regime progresses, and seeing if, of course, if these companies can continue to finance operations, particularly amid all the financial sanctions. In terms of execution, most of our clients who are still active in the market are demanding prepayment and demanding that as much as possible in foreign currency. Some of the biggest complaints we're hearing are issues related to timely payment and payment in hard currency from local counterparts within the Russian market. And then, of course, with the extreme drop in demand, firms should most definitely be expecting, with obviously no surprise here, extreme margin erosion for the indefinite future, for as long as this situation lasts. So that's, broadly speaking, what we are hearing from the market. In particular, the biggest issue, which relates directly to the sanctions and why it'll be extraordinarily difficult to be operating the market as the sanctions regime stays, is the difficulty of procuring supply, of importing products, of getting the necessary components and parts, and just simply the core finished product brands, the products that are sold in the market, which of course is massively disruptive. particularly as inventories start to run out in the relatively near future.
So Mark, before we move on to the global applications, can I just confirm something? Your protracted stalemate scenario, the base case scenario that you shared with us, that scenario assumes no lifting of sanctions anytime soon. Is that correct?
Correct.
Got it. So we're expecting Russian market under sanctions basically for the remainder of this year, most likely.
Correct. And even in a situation where Putin were to pull forces out of Russia, the fact that Putin remains in power, the sanctions also in that case overwhelmingly likely would still remain in place, even if the formal hostilities end, though Putin's regime survives.
Got it. Okay, we're getting some questions through as well. Thank you everybody for dropping them. We are keeping an eye on them, and if you have more in the next section, let us know. We'll get to them in the Q&A session. But at this point, we should talk about the global implications. So I'll pass it on to Elizabeth to help us understand what this means for outside of Russia, Ukraine, markets globally and executives.
Great, thanks, Martina. As you can imagine, lots of global implications to consider, and so we're just going to spend a few minutes talking about several of these on a very high level. Of course, as you have questions, please keep them coming in. To help frame this discussion, I thought it would be useful to illustrate how we saw the global economy in mid-February on the eve of Russia's invasion of Ukraine. Already at that time, we were assessing obviously a number of tailwinds to global growth this year. High global immunity to COVID-19 sort of gradually posing less of a hit to demand, strong consumer balance sheets, especially in developed markets, very strong manufacturing activity globally, actually in general over the course of the last year, easing travel restrictions. So a number of positive factors, tailwinds for global growth. We also were assessing a number of factors we already knew were going to weigh on global growth this year. So continued supply chain issues, high and rising commodity prices. They've been high and rising for about the last year, as well as high global inflation and the potential for inflation to rise even further. And then, of course, we were factoring in the potential for a number of downside risks. They weren't factored into our base case then forecast of 4.0% for 2022, but we had them on our radar. And then going on to the next slide, this is how we assess the changes to those factors now that that war in Ukraine event has been triggered. So obviously that alone is causing instability in Europe, a surge in global commodity prices, and it's triggered a number of other of these issues. It's taken some of the wind out of the sails for some of these positive factors. So we are anticipating some slowdown in global manufacturing activity resulting from this. And a lot of that has to do with deterioration in supply chains, even higher and commodity prices that will be rising even faster now, and even higher inflation. And it's also kind of raised the probability of some of these other downside risks, like turmoil in global credit markets, as well as rising food prices, the potential for social unrest. One theme of this discussion will be sort of what are the other downside risks that get triggered as a result of this, due to the fact that events tend to beget more events. If you have a chaotic situation, it's going to tend to trigger other downside scenarios, and that will be something we allude to throughout. If we go on to the next slide, majority of this discussion will be to talk about the immediate implications on supply chains, energy, and commodities, since that's sort of the biggest obvious factor that this war in Ukraine is affecting in terms of both the impacts on global growth and demand, as well as the direct impacts on our clients as they're reassessing their supply chains, dealing with a lot of these shipping challenges and rising input costs. This is a framework we've been using for the last several months, as we've already been in an environment of strained supply chains and high input costs. On the left, we list several factors that are really important to our clients, and then the cost outlook. So in red is where we indicate potential for high prices, as well as upside risk, so the potential for prices to rise even further. In orange, we were signaling high prices, but with balanced risk, and in green are easing or lower prices. So as you can see, even prior to the outbreak of war in Ukraine, we were anticipating high prices for shipping with the potential for prices to rise further. Same for oil and natural gas and agricultural commodities. But the outbreak of war in Ukraine has worsened the situation, so there are even more upside risks in the short to medium term, and then the potential for prices to remain higher for even longer. So we will now go into each of these factors, starting with shipping. This is a measure from the New York Federal Reserve that kind of puts together a number of different measures of global supply chain pressures. So these include global dry bulk and container shipping prices, cross-regional air freight prices, as well as data from purchasing managers' surveys on shipping delays, delivery delays, inventories, et cetera, and kind of putting all those together, you can get a measure of global supply chain pressure. As you can see, and this data does not fully incorporate the impacts of the war due to lag effects. As you can see, supply chain pressures were already at historically high levels prior to the war, with a little bit of a sign of easing, but that's now irrelevant at this point. We are expecting this measure to go up, and for our clients to experience even greater strains on their own supply chains, even greater issues with high shipping costs and difficulty shipping their goods around the world. If we go on to the next slide, talking specifically about our expectations for container shipping prices, which we know has been top of mind for our clients for the last several months, and that's going to continue to be the case. Container shipping prices were already at historically high levels prior to this. We saw a little bit of an easing late last year, and calls for continued easing actually turned out to be a bit too optimistic, already seeing a pickup earlier this year, and we're expecting those prices to rise further. One main reason for that is that shipping around the Black Sea has gotten significantly more complicated since the outbreak of this war due to the closure of Ukrainian ports, due to the sanctions on Russia, due to self-sanctioning, so reluctance for shippers to dock at Russian ports, and due to, given the sanctions, just the challenges of financing shipping, just the challenges of moving through a complex web of sanctions. That's all raised shipping costs and challenges around the Black Sea. And even though Russia and Ukraine are not sort of big players in global shipping networks, the Black Sea is. It's a big thoroughfare for global shipping. So that's one big reason why we're anticipating greater supply chain challenges coming out of this. Another big factor, even a bigger one, going on to the next slide, is air freight. And as you can see, and as our clients were noticing and experiencing prior to this, we've been in an environment of very high air freight prices for ever since the outbreak of the pandemic. And that had a lot to do with the decline in global air passenger capacity, given that that's a major channel through which air freight moves. And again, this data, due to lag effects, does not fully incorporate the effects of the war, but we were already in an environment of high air freight prices going into this, particularly for air freight going in and out of Asia due to strict travel restrictions for most APAC markets. And now we're anticipating even further deterioration, especially for air freight moving between Europe and Asia. Three kind of offhand reasons for that. One is with the closure of Russian airspace. Both commercial passenger and air cargo jets will have to move around Russian airspace, which adds considerably to cost and delivery times. Russia is also home to a number of major air cargo airlines, which have now been taken out of the system. And Ukraine was also a pretty significant manufacturer of jumbo air cargo jets under the Antonov brands. So putting all those factors together, we've thrown a major new wrench into the system of global air freight, and are therefore anticipating higher prices going forward. Going on to the next slide, getting into the energy question. And I will actually, and I should have kind of started this caveating, underlining some of the points Martina and Mark made earlier, that in all of our assessments about where prices are going for shipping as well as energy and commodities are under our assumption that sanctions on Russia, those that have been put in place, will last for a while. And even with potentially some limited lifting of sanctions, the deterioration in Russia's economy is also going to limit supply and throw more snags into global supply chains. So as we assess the impact of oil and take into account all of the chaos that's occurred in oil markets in the last 2 weeks, all of the upside and downside risks, we are obviously anticipating a higher oil price environment this year. That is no question. We already were even prior to this, and obviously prices are going to be higher as a result of this. Russia supplies 10% of global oil, and if you take most of that supply online, as has been the case as a result of the financial sanctions put in place, as well as the self-sanctioning that's taken place by oil majors, that's going to push up prices. However, there are a mix of upside and downside risks. There is recourse in terms of global oil supply. That's not to say it's easy to bring that supply online, which is why we're seeing higher prices. But that's why we're not forecasting necessarily $200 barrel oil for the rest of the year. But we are in a high environment of high price volatility, and so we will see continued major swings in oil prices. Our overall upward revision to forecast, we've raised the annual forecast for Brent crude from $85 to $89 a barrel. That will probably have to rise a bit further, but there are, again, some downside factors for oil prices. So in terms of the base case uncertainties, we're taking into account, obviously, that sanctions persist, that self-sanctioning by oil majors persists to a great extent. But we are anticipating some downward pressure on prices from further releases from strategic petroleum reserves coordinated by the International Energy Administration. We already saw one release several days ago of about 60 million barrels of oil, and there will be more. There is more oil that can be brought online by oil-consuming nations from their strategic petroleum reserves, and that will help at least curb increases in oil prices. Not a major factor, but it is one in the mix. We are still anticipating that some Iran nuclear deal could bring some modest supply online in late 2022 and may help bring prices down even a bit prior to that. Some questions about that outlook, but that is one factor that could contribute to bringing prices down. But then there are a lot of risks and uncertainties. There's obviously the potential for even harsher sanctions that more directly target the energy sector. Mark has obviously alluded to oil import bans by the US and UK, not a big factor yet, but if there are more bans and targeting of the energy sector along those lines, that will raise prices further. There's the potential for outright conflict in the Black Sea that could take some Azerbaijani and Kazakhstani supply offline as well. There's the potential for energy infrastructure damage. There's also the potential, obviously, for further retaliatory actions by Russia, like oil export bans. On the kind of positive side for supply, there are potential increases from OPEC. The UAE signaled yesterday its desire for OPEC to increase supply. We don't know whether that is happening, but if prices do shoot well past $150 a barrel, that scenario becomes much more likely. There's the potential for more US supply later this year. So putting all these factors together, we are anticipating obviously a high oil price environment, but with high volatility, prices swinging wildly based on signals about future supply potentially coming online or more energy sanctions going in place. So we're encouraging clients to anticipate that. Higher oil prices, but with a lot of uncertainty and volatility. Continuing with energy, but going on to the next slide with gas. So this is a bit of a different story from oil. It's similar in that due to sanctions and the risk of retaliatory action by Russia cutting off gas supply, Europe's benchmark gas price has been swinging wildly in the last several days and continues to break new records. But different from oil, there's less supply recourse for Europe. Russia supplies about a third of Europe's gas needs. In terms of gas needs and electricity, there's obviously Europe relies on renewables and coal to some extent, but it's suffice to say Europe is very, very dependent on Russian gas. And if that flow were to be cut off today or tomorrow, which is possible, it is not clear how Europe would cope. It would certainly result in some amount of demand destruction in Europe, decline in manufacturing activity, both due to electricity shortages as well as natural gas shortages for use in manufacturing as feedstock. So this is obviously a major risk to the outlook. We don't know yet whether Russia will cut off supply, but it's a big factor we're watching that will have big implications if it does occur. Going on to the next slide, talking about some other commodities. As we know, the war in Ukraine has massively driven up the price for a number of agricultural commodities, particularly wheat, given that Russia and Ukraine account for about a quarter of global wheat supply. And that's fed into prices for some other commodities due to spillover effects, substitution effects, but in general, due to how large especially Ukraine and also Russia loom in global agricultural markets, as well as in fertilizer markets, agricultural commodities have been on a tailspin, and there's not much to arrest these increases. The rate of increase might slow. There will be lots of volatility, but we are definitely anticipating higher food commodity prices for longer. And same deal for a number of metals. Going on to the next slide. We've seen surges in a number of the prices for a number of base metals ever since the invasion, particularly aluminum, especially nickel. That price actually for nickel is not even real. The surge in prices for nickel threw the London Metals Exchange into such a tailspin that they had to halt trading until tomorrow. And that has to do, again, with the large share of supply accounted for by Russia and Ukraine. There's been also a bit of pressure on other metals like copper and cobalt, potentially greater pressure as markets continue to take into account all of the disruptions to supply. And in terms of why this is happening, the next couple of slides illustrate what we're talking about. If we go on to the next slide, so Russia, Ukraine, and Belarus together comprise a very large share of supply across dozens of different commodities to varying extents. So it's very bad for sunflower oil, where they account for over 2/3 of global supply. And then go on down the list, neon gas, which is a major input to semiconductor manufacturing, along with several other noble gases. Those three countries together comprise 40 to 50% of the global market for those gases. Fertilizers, which I talked about, as well as several other metals and food commodities. This isn't even an exhaustive list, but it's some of the most important ones. If we go on to the next slide, we've just illustrated some of the uses of these commodities. I'm sure as companies, you are well aware of where your inputs come from, but we wanted to illustrate some of this also to think about second order effects. So what inputs are your suppliers reliant on? What inputs are your customers reliant on? How is a disruption to these commodities going to impact the entire supply chain? And it's important to kind of think broadly, as we have started to do, about the uses of these commodities that go past kind of the obvious first thing you think about. So, for example, a number of these food commodities are not only for food that people eat, it's also for animal feed, for use in biodiesel, for use in cosmetics, for use in alcohol products. So it kind of illustrates the degree of supply chain disruption that we are talking about, and the likelihood that going forward, we're not just talking about high input costs as our clients have been experiencing, we're talking potentially about outright shortages in a lot of cases. When you take a large share of the supply offline, that's what you're going to get. Now, I will note that the share accounted for here, that doesn't mean that 25% of wheat supply is gone in an instant. There is some wheat still being exported from Russia and Ukraine. But a significant share of that has gone offline, and then there's kind of different dynamics for each of these. So we know for wheat, planting cycles in Ukraine have been significantly disrupted because they're in the middle of a war and farmers can't plant. So that's kind of illustrating what we're talking about. If we go on to the next slide, we just wanted to share some thoughts on what alternative suppliers there are for some of these commodities, and there are kind of two takeaways to draw from this. One, where can you think about if you're thinking about alternative places to source some of these commodities? And also for us, we're factoring it into our forecast revisions for some of these markets, considering which of these markets have extractive and production sectors that may benefit a little bit from the higher prices for these commodities. There aren't really any winners from this war, especially due to very complex global supply chains. But for some of these markets listed here, there may be some minor upside. A lot of them are located in the Americas, so especially US, Canada, Argentina, as well as Australia, big commodity exporters. If we go on to the next slide, that's kind of the other side of the equation. So which are the countries that are very dependent on imports of these commodities from Russia, Ukraine, and Belarus, as well as dependent on those imports in general? A few themes to draw here. China and Asia Pacific, printed in red, are some of those most dependent on the commodities kind of in the top half of the page. Western Europe is very dependent on imports of metals in particular that go into the manufacturing supply chain, and Middle East and North African economies are very dependent on food commodities from Russia and Ukraine. So those are some of the disruptions that we're anticipating to those economies. If we go on to the next slide, some of the implications for all of the supply chain disruption, it's going to feed into higher inflation. We were already dealing with high inflation and soaring producer prices before this, and it's going to go up further due to cost push inflation, so pass through high producer prices feeding into high consumer prices. By the way, that 7.5 CPI inflation figure for the United States, the new figure for February just came out about an hour ago. It's actually 7.9% now, so that's an illustration of the strong inflationary pressures that we're anticipating across a number of major markets. Going on to the next slide, we wanted to kind of give a schema for our clients in thinking about their pass-through decisions, how they're evaluating their pricing strategies. High inflation is going to lead to some amount of consumer demand destruction in every market, but the degree will vary across markets. And so this is an index we've put together taking into account near-term inflationary pressures, so how much higher has inflation been relative to recent history, as well as how dependent consumers in these markets are on food and energy. So what share of food and energy is comprised in the consumption basket? And with soaring food and energy prices that we're anticipating are going to rise even further, we're anticipating those consumers in those markets are going to be engaged in a greater degree of trading down, decline in consumption of other goods. So this is a big risk that we're saying, not really a risk, just to some extent a certainty that we're anticipating for clients, and we'll be producing more research on this as we learn more in the coming weeks. If we go on to the next slide, wanted to talk just a minute. We've talked a lot about energy, commodities, supply chain, inflation as some of the immediate impacts of the war. But one other channel through which this is going to affect global economic activity and growth is through the economic impact on Europe. Because Russia and Ukraine are so implicated in European supply chains, we have massively revised our forecasts for European macroeconomic indicators already. On a high level, we're expecting much higher inflation, particularly due to higher energy costs. That's not even taking into account the risk of a cutoff in gas flow that's just due to higher natural gas prices we've seen already and higher oil prices. We're expecting much higher producer prices in Europe and much higher inflation overall. That feeds into the next slide, where we're expecting lower growth as a result, growth likely to be cut in half for 2022 in Europe as a result of the war in Ukraine. And again, that is going to affect the rest of the world in terms of economies that are dependent on European demand, imports from Europe, etc. If we go on to the next slide, just a really quick note on central bank policy. We don't have tons of time to talk about this, but this situation has made things much more complicated for developed market central banks, which are now facing the dilemma of lower growth and higher inflation. So obviously they are inclined to raise interest rates to help control inflation, but it's much harder to do that in an environment of slowing growth, supply chain disruption, etc. So overall, we're expecting the ECB to continue to slow roll the rate increases, and a lot of that has to do with the spread in bond yields between northern and southern markets. The ECB is very concerned about provoking another Eurozone crisis because of this. And for the Fed, going on to the next slide, we've noted that market expectations for Fed hikes have eased quite a bit since the invasion began. Basically, markets anticipating that there will be a slowdown in US growth and that the Fed is going to slow roll rate hikes to some extent. But as we know, the US is facing accelerating inflation, and so some amount of rate hikes will occur. If we go on to the next slide, I'll just leave this on a quick note. Again, I kind of talked at the beginning about beware of second order ripple effects, other major events that may be triggered from this. A couple of these have already been triggered. This is our global events to watch framework that we put out in November. So we already have seen oil prices surge above $100 a barrel. Think through what the implications are for that. But one I wanted to highlight was global food shortages triggering social unrest. This is already a big risk we had on our radar last November, and it's now become much more likely. If we go into the next slide, you can see where global food prices, the trend in the last year, they're already at all-time highs with data going back to the 50s. And this is, again, before the war in Ukraine, this data. And so those prices are only going to rise higher, not only due to the increase in food commodity prices, but also due to increase in shipping costs, labor costs, just general inflationary pressures. Going on to the last slide, just again, we haven't had full time to assess all these factors, and we won't have time to get into them today, but there are many other spillover effects that we are watching from this. Second and third order macroeconomic spillovers into other geographic markets. We are really in the process right now of revising our growth and macroeconomic indicator forecasts across all of the markets that we cover. Some of the ones that we're expecting to see higher risk, greater downgrades are non-oil exporting countries in MENA, South Asia, car producing countries, because we're expecting big disruptions to global auto production. Second order supply chain disruption. So we've talked about the disruption to commodity supply from Russia, Ukraine, but as we see lower industrial production in Europe, there will be disruptions to commodities that Western Europe is active in, like steel, chemicals, financial spillovers from sanctions, another big factor we're keeping an eye on, currency and bond risk and some vulnerable emerging markets, and then other geopolitical surprises that could result from this. And on that cheering note, I think we want to leave a little bit of time for Q&A. I don't know if we've gotten any questions in the last few minutes.
We have, yes, thank you very much, Elizabeth. So hopefully this illustrates why we talked at the beginning of this conversation about the implications this has for demand planning, for price sensitivity, and how you think about your pricing risk, for supply chain restructuring, as well as political risk management. All of these are strongly indicated by all of the analysis that we have seen so far and some of these global ripple effects. So as Elizabeth said, we are moving into the Q&A section of our conversation. We have received a number of questions, and I wanted to merge a couple that are all going at kind of the same element of inquiry, which is around where else multinationals might invest given the impact that this crisis is having on Russia and Ukraine, and also on Europe and European growth as well. And I might take this one, and then I have a few questions for both Elizabeth and Mark. This is really a question about two things. One is how are corporations thinking about where else they might be able to make up for some of the slack that this has created, and also winners and losers from a geographic perspective. As Elizabeth said, there aren't really that many true winners who have seen no negative exposure to this crisis, but a small number of countries that are heavily exporting energy. So I would say Saudi is one market to look at, because with these energy prices, their government revenues, of course, have been boosted substantially. But because food and energy costs are feeding through supply chains everywhere, as well as consumers everywhere, there is really mostly a difference in terms of impact intensity, but the consumers around the world will lose from this situation more broadly. Countries with strong export linkages to Europe will also be affected, and so that's where we might see a little bit of additional slack and weakness. That said, there is a question about whether Asia Pacific might have elements of gaining from an investment perspective from this environment. I would say there's probably going to be more pressure on targets as associated with APAC. So we can see situations where corporate goes to the Asia teams and says, we need you to do more, because we have seen downgrades to our European growth, and Russia and Ukraine are just offline completely. And therefore, we have to make this up somewhere else. And where can we make it up? Asia looks like a good place to do so. Asia always looks like a good place to make it up. The detail and the challenge is in the execution and the ability to pull this off, in particular where you have markets like India, for example, that are going to be strongly affected by high food and energy prices. And even in China, which looks quite resilient in this entire picture, some of these prices are going to feed through producer inflation despite efforts by the government to control them. And we know that with the zero COVID policy as well, there are risks to Chinese performance. Together with some of the pressures on the real estate sector that mean it's not a market in which you can just make easy money the way that it maybe has been perceived some years past. We think that more attention may be directed now towards Latin America. Not to say that region is not affected by this, but there may be some benefits that it sees in terms of corporate attention, and also potentially Middle East, parts of the Middle East, in particular energy exporting markets, that might be seen as helping to make up for it. But weak European growth is bad news for pretty much everybody else out there. And of course, that could potentially play out. We also do see relatively resilient growth in the US, even with this higher inflation. And so we could potentially see more pressure coming back onto US targets as companies are looking to make up for the reduction in demand there as well. So just a couple of observations of how we see potential restructuring of corporate objectives happening in light of this this crisis. I have a question for Mark, actually a couple of questions for Mark. So number one, considering the economic crisis that you're expecting in Russia, this is specific to Russia, how do you expect government spending to react? Do you expect cuts to healthcare spending, social spending? Do you expect a lot of government support? And in what would be the priority areas from a spending perspective?
Right. Well, budget revenues are going to come under considerable pressure. They were already going to come under a lot of pressure before. Now, in expectation of a voluntary cut to exports of the primary commodities that feed the budget, oil and gas being about 40% of budget revenues, if they're voluntarily going to be cutting that, they're going to have to reallocate spending. From a political perspective, this means things like the infrastructure projects, the road building, the national projects, and different things focus on demography or IT, and some of these areas are much more elective and can be pushed far down the road. In the more immediate future, from a political point of view, right, this would mean that you're going to see much higher social spending support, healthcare support as well. So reallocation there, and then obviously reallocation towards defense and security services sector. You can't afford to have people on the streets. So you're going to see, to the point also, I mean, as we've seen in the example, say, of Venezuela, Russia effectively in a weekend undid 25 years of improved living standards and turned itself into an Iran and Venezuela and moved towards economic autarky, which means we'll probably see similar patterns as we've seen, for example, in Venezuela, which means printing money at some point in order to also help sort of moderate, or at least the feeling of declined living standards for people, to help sort of stop the bleeding temporarily. But of course, that just accrues problems over time and exacerbates existing macroeconomic issues.
Got it. One more question, this one relating to Poland, Mark. Is there a risk of Russia retaliating directly against Poland, given how much support Poland is giving to Ukraine?
Sure, absolutely. So first answer is yes. The second part of that answer is that I would say we're moderately encouraged the fact that they have not to this point. There has been considerable amount of support, both in terms of manpower coming through Poland, foreign fighters, as well as Ukrainians turning around, coming back into the country, and then also, of course, in terms of money and then material support and arms and et cetera. And the fact that Putin, who, by the way, on the day of the invasion, said in his announcement that if he saw involvement from the West, he would consider that an act of war. The fact that he has not retaliated against that directly is relatively encouraging. That he still is sort of weighing costs and benefits. At this point, it seems does not want to escalate this into a third world war, making this a direct conflict with NATO. This is a risk, though, Critically, though, the U.S. and Russian military are actually, they've opened up lines of communication to try to reduce the potential for an inadvertent bombing, for example, on the other side of the border. So hopefully that reduces the risk there, but this risk is going to continue, particularly as we move into this counterinsurgency, this protracted stalemate, and the potential for a mistake, if not Putin overtly deciding he wants to escalate the war to become a hot war with NATO.
Understood. Thank you, Mark. Now, with this, unfortunately, we are running out of time. There are a few questions we have not been able to answer, but we will follow up with you afterwards to make sure that you get our feedback on the question that you've asked. You also will be able to view the materials that we shared today in the recording of the webinar on our mobile app, which is available on iOS and Android. For anybody on the line who is interested in complimentary access to our suite of resources, including data, dashboards, and a lot of the market monitoring and analysis we've been doing, please let us know by messaging us at info@frontierview.com. For those of you who joined us, thank you very much for your time. We appreciate it. We look forward to having you join us for our next conversation, and we wish you best of luck for the rest of your day. Thank you, everybody. This concludes our webinar.
Take care.